I think when silver gets above 50, which it's going to do, once we break through 50, I think that's going to be the new support. So 50 is going to be the dip that you hope to buy silver at. So right now, you got to double from here just to get to what's going to be the new floor. Just like I was saying that 2000 was the floor on gold, soon 50 will be the floor on silver. Most people who are waiting for a pullback in either gold or silver will end up buying at a much higher price than if they just bought right now. So as far as I'm concerned, if you want to buy gold or silver, you just buy it right now.
Gold prices remained stable on Friday and are expected to register their first weekly decline in 4 weeks due to diminishing expectations of a U.S. interest rate cut. This shift in sentiment came after data releases during the week that indicated mounting price pressures in the economy. Spot gold held steady at $2,159.99 per ounce. PeterSchiff, chief economist and global strategist at Euro-Pacific Asset Management, observed an unexpected market reaction to inflation data that exceeded expectations. Contrary to historical patterns, gold prices declined by over $20 despite the worse-than-anticipated inflation figures, surprising many investors. In contrast, silver, valued for its industrial applications and as a store of value, experienced gains after the release of U.S. industrial production data, surpassed estimates with a 0.1% rise in February, defying economists' flat growth projections. Peter highlights gold and silver's resilience despite initial price drops, especially noting silver's strong recovery. He remains bullish on silver, believing it has significant potential for growth, possibly doubling to reach previous highs. Gold is now a top pick by J.P. Morgan Chase Incorporated, surging to a new all-time high of $2,195.15 per ounce. Discussions about its potential ascent are fueled by predictions, including one from Natasha Kaneva, J.P. Morgan's global head of commodities research, suggesting it could reach $2,500 per ounce this year. Peter advises against waiting for dips in gold and silver prices, as any declines could be short-lived. He recommends buying now to avoid missing out on lower prices and facing higher costs later. Join us as we delve into PeterSchiff's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The hotter than expected CPI numbers that came out yesterday, and despite the fact that they were hotter than expected, the markets didn't seem to worry too much about it because the markets were higher generally, although there were, some of the NASDAQ stocks were coming down a bit today and yesterday as well. But the main market that got hit was gold. Gold was down over $20, which, as the prices are higher, $20 is not as big a move as it was when gold was $1,000, now that it's closer to $2,200. But gold dropped $20, maybe a little bit more. And the catalyst, again, was that inflation was worse than expected. Now, I've been saying on this podcast that that's actually good for gold. Worse inflation is good for gold. It's not bad for gold. But the market still looks at it the other way because in their mind, inflation is worse than we thought. It just means that the Fed is going to have to delay these rate cuts for another month or two. And that means the computer algorithms sell gold, right? But the reality is it doesn't even matter when the rate cuts come. Gold's going up because the Fed shouldn't even be cutting rates. The Fed should be hiking rates. The market still doesn't get that. Again, they just think the hotter than expected inflation numbers means the Fed has to fight a little bit longer to make sure inflation is at 2%. And all it has to do to assure that is postpone the first cut by a month or two. But that's not the case. It doesn't mean the Fed has to fight a little harder. It means the Fed hasn't fought enough and it's lost and inflation has won. And so inflation is going to keep getting worse. And so you should be buying gold. But even though gold went down yesterday, it didn't stay down because today it almost recovered all of yesterday's losses. It came pretty close. Silver recovered a lot more of yesterday's losses. In fact, silver had one of the strongest days I've seen. It was up better than 70 cents an ounce. In fact, as I'm watching now it trade, it's actually at $25, which is higher than I think it got at any point during U.S. Trading hours. 25.05, 25.06, up 10 cents. So I don't think we hit $25 during market hours in the U.S. today, and now we're above $25. I've been really, telling people on this podcast recently to buy silver, and now it's moving. And silver still has to double to get back to its high from 2011, which is the same high it had in 1980. Imagine that. I mean, how many things can you buy for half of the price that people were paying in 1980? A lot of the people that watch this broadcast weren't even born in 1980. I think when silver gets above 50, which it's going to do, once we break through 50, I think that's going to be the new support. 50 is going to be the dip that you hope to buy silver at. So right now, you got to double from here just to get to what's going to be the new floor. Just like I was saying that 2000 was the floor on gold, soon 50 will be the floor on silver. So right now, you're so far beneath that floor that it's a great buying opportunity. I talked to the guys at Schiff Gold, and business has been picking up, but they tell me that there are still some people that are waiting for a pullback. You've got your pullback already. That's gone. At this point, you don't wait for a pullback, you buy. Now, that doesn't mean that there can't be a pullback. There always will be pullbacks. I just think they're not going to be substantial enough for it to be worth the risk. The pullbacks will be so shallow and so quick that you'll probably miss them anyway. And I think most people who are waiting for a pullback in either gold or silver will end up buying at a much higher price than if they just bought right now.
The Labor Department reported that the annual inflation rate stood at 3.2% in February, slightly up from January's 3.1%. This monthly update arrives amidst a critical presidential election year, and as the U.S. Federal Reserve deliberates its next moves to combat rising prices. Peter suggests that even if inflation eases to 2%, significant interest rate cuts wouldn't be justified. He argues that maintaining positive interest rates is essential to ensure real returns for investors after factoring in inflation. Lowering rates excessively could risk negative real returns for investors. As policymakers prepare to unveil fresh quarterly projections at the meeting, the persistently high inflation rate raises the possibility of signaling fewer interest rate cuts this year compared to initial expectations. Peter cautions that the Federal Reserve faces constraints in significantly reducing rates, even if inflation decreases. Aggressive rate cuts could worsen inflation by boosting borrowing and spending and increasing demand and prices. Let's get back to the interview.
Conventional wisdom that the Fed has won the inflation war, that its rate hikes have done the trick. The inflation genie is back in the bottle. Sure, it's not quite 2%. It's a little over 3%, but we've gone from 9 to 3, so we're most of the way there. And it's just a matter of time, and we're just going to coast down to 2% and magically stay there. And because of this, the Fed could substantially cut interest rates because we don't need 5% interest rates anymore. We could substantially reduce them once inflation goes back down to 2%. And I've been saying that is complete nonsense. That view could not be more widely held, yet it could not be more wrong. I mean, first of all, even if inflation was going to go down to 2%, substantial reductions in interest rates would not be warranted because you have to have a positive rate of interest. So let's say inflation is 2%. If rates are 4%, you're only earning 2% after inflation. And a lot of people pay taxes on that 2%. So 4% maybe if inflation's 2%. Well, we're not that much higher than 4% now. We're, 5%, 5.25%. And if you look at 30-year treasuries, 10-year treasuries, they're just over 4%. So they're priced right now for 2% inflation. But we're not going to get 2% inflation. And even if we were, there's not a lot of room for the Fed to cut. Because if they were to bring rates down to 3% or 2%, inflation wouldn't stay at 2%. That would make it move up. But the reality is it's worse than that because inflation isn't going to coast down to 2%. It's already headed back up to 9% and probably higher than that. And the data supports this conclusion. So for people to believe this nonsense about inflation, they either have to be blind to this data or they're deliberately being disingenuous about these forecasts. And let's start with the CPI number that came out yesterday. This is the February CPI. We're going to get producer prices, I think Thursday, what would be tomorrow. So I'll talk about them next time. But the CPI came out as I expected. It was hotter than expected, meaning higher, revealing more inflation. Now, the headline number was not higher than expected. They were looking for up 0.4, but up 0.4 is a big number. It's not indicative of 2% inflation. 0.4 is more like 5% inflation, right? If you have 0.4 every month. If you think we're going down to 2%, this 0.4 certainly doesn't confirm that. But I guess the markets thought, well, it'll be a one-off number and then it's just going to go down, right? That's wishful thinking. But the year-over-year headline number actually inched up. It went from 3.1 to 3.2. Now, that's the wrong direction. If everybody thinks we're headed to 2, why did we just move higher? Why do we move to 3.2? We're going up, not down. The core number, excluding food and energy, that was the beat or the higher number. It was supposed to drop to 0.3 from 0.4 in January, but instead we got another 0.4. So back-to-back 0.4s in the core. That is a high number. You need the number to be half that if you're trying to get 2% inflation. So the number is double what the Fed would need.
In what ways do you anticipate geopolitical and economic factors, such as the upcoming presidential election and global market volatility, influencing precious metals markets in the near future? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.